One life insurance decision can quietly cost you tens of thousands of dollars and lock you in for decades. And most people pick wrong because nobody ever explains it simply. It usually comes down to two choices: term life and whole life insurance. They sound similar, but the difference between them could be a small fortune. Let us make it crystal clear. First, what is life insurance even for? It is simple. You pay a small amount regularly, and if you pass away while covered, your family receives a large payout. At its heart, life insurance is income replacement. It is there so that if something happens to you, the people who depend on your income are not left in financial ruin. It is not really about you. It is about them. Life insurance is one of the most selfless purchases you can make, a promise that the people you love will be okay no matter what. So the first question is not which type, but whether you need it at all. If people depend on your income, a spouse, kids, or shared debts, then yes, you very likely do. But if you are single with no kids and nobody relying on your paycheck, you may not need much life insurance at all. Do not buy protection for a risk you do not actually have. Now the first type, term life insurance. It covers you for a set period, like 10, 20, or 30 years. If you pass away during that term, your family gets the payout. It is pure, simple protection. And because it only lasts a set time, it is remarkably cheap. A young, healthy person can get a large amount of coverage for a small monthly cost. The catch is that if you outlive the term, the coverage simply ends, and you do not get any money back. But that is exactly why it is so cheap. You are paying only for protection. The second type, whole life insurance, also called permanent insurance. It covers you for your entire life. It never expires, and it also builds something called cash value. That cash value is like a small savings account baked into the policy. Part of your payment goes to insurance, and part slowly builds up money you can borrow against later. It sounds amazing. Coverage forever, plus a built-in savings pot. So why does almost every honest money expert tell most people to avoid it? Here is the catch. Whole life is expensive, often 5 to 15 times the cost of the same coverage in term. That huge premium is the price of the cash value and the lifelong coverage. And here is the part salespeople gloss over. As an investment, that cash value usually grows slowly, weighed down by high fees and costs. It often underperforms simple investing by a lot. There is also a reason it gets pushed so hard. Whole life policies pay salespeople big commissions, so the person selling it often has a strong incentive to talk you into it. This leads to the strategy most experts swear by: buy term and invest the difference. Get cheap term insurance for protection, then invest the money you save yourself. Remember index funds and compound interest? Instead of overpaying for whole life, you take that difference and grow it in low-cost investments that you fully control. Over the years, this usually leaves you with far more money, plus solid protection while you needed it. You get the best of both worlds without the bloated premiums. Think about it over a lifetime. 20 or 30 years of investing that difference, compounding the whole way, can grow into a sum that dwarfs any cash value a policy would have built. And here is the beautiful part of the plan. The goal is to eventually not need insurance at all. By the time your term ends, you aim to have built real wealth of your own. Your kids are grown, your mortgage is paid, and your investments have grown large. At that point, you are self-insured. Your own wealth is the safety net, and the insurance has done its job. Now, to be fair, whole life is not always wrong. For a small group of people, it can make sense, like the very wealthy using it for complex estate planning, or families with a lifelong dependent, like a child with special needs who will always require support. In those specific cases, permanent coverage can be a genuine and valuable tool. But for the average person just trying to protect their family while they build wealth, simple term insurance is almost always the smarter, cheaper choice. The insurance industry is not evil, but it is a business. Many products are designed to sound impressive and pay big commissions. Your job is to buy only what protects your family. So how much coverage should you get? A common rule of thumb is around 10 times your annual income, enough to replace your earnings for many years. A better way is to add it up. Enough to pay off your debts, cover your mortgage, replace your income for years, and fund your kids until they are grown and independent. How long should the term be? Long enough to cover the years your family truly depends on you. Often, that means until the mortgage is paid and the kids are grown. A 20 or 30-year term is common for young parents because it carries them through the most financially vulnerable stretch of their lives. Match the term to the need. One more powerful tip: Buy it while you are young and healthy. Life insurance gets more expensive as you age and as health issues appear. Locking in early saves a lot. A long-term policy bought in your 20s or 30s can lock in a low rate for decades. Waiting can mean paying far more or struggling to qualify at all later on. Also, look for a policy that is convertible or renewable if you can. It gives you flexibility later in case your needs change in ways you cannot predict today. And please, do not get pressured. If a salesperson pushes whole life hard and waves you off term, that is a signal to slow down and ask exactly how they are getting paid. Get a few quotes, compare honestly, and never buy more complexity than you actually need. Simple, cheap term plus your own investing is a very hard combination to beat. Let us recap. Term life is cheap, simple protection for a set number of years. Whole life is far more expensive, lasts forever, and builds slow-growing cash value. For most people, buy affordable term, invest the difference in low-cost funds, and aim to become self-insured. Save whole life for the rare, special situations where it truly fits. Done right, you protect the people you love and build real wealth at the same time, without ever overpaying a salesperson for something you did not need. So now I want to hear from you. Do you have life insurance yet? And were you ever pushed toward whole life? Drop your story in the comments below. If this finally made life insurance make sense, hit that like button, subscribe for more simple money lessons, and share it with someone shopping for coverage.